Hello and welcome to this week's fund review. Today we're going to focus on the Fidelity ContraFund, but before we get into that, let's get into our disclosures. This video provides general education. Nothing shared in this video is to be considered specific tax, legal, or investment advice. So certainly don't act on any information that you see in this group without first consulting with your tax, legal, or investment advisor. Fidelity ContraFund was selected as the fund for the week based on a poll in my Facebook group. And what we did is we picked the 10 largest actively managed large cap funds, and we put a poll together to see which ones people would like to see reviewed. Fidelity ContraFund was by far and away the winner with more than twice the votes of the American Funds Growth Fund of America. So given how active Fidelity is in the retirement plan space and the size of Fidelity ContraFund, we certainly were surprised to see it come out first in the voting. So thank you for everybody who's joined the group and who's been active and voted in polls like this. We'll continue to do these fund reviews and we'll post polls like this every week. So be sure to log on and make your vote. Fidelity ContraFund is a large cap growth fund. So for those of you who understand the Morningstar style box, the bottom three boxes are for small cap funds, middle three for mid cap, top three for large cap funds. The left side of the box is for value, the right side is for growth. So the yellow square here indicates that it's a large cap growth fund. So what does that mean? That means it invests in large cap companies who are expected to grow at a faster pace than the market. So if you look at the top three holdings, top three investments in Fidelity ContraFund, Amazon, Facebook, and Microsoft are the top three. So these are stocks that the portfolio manager has selected with the idea that they will outperform the market. When you take a closer look at the top 10 holdings, the number one holding, Amazon, makes up 8.5% of the fund. And that's interesting when you compare that to the overall S&P, of which Amazon takes up about 4% of. On the other side, you've got Apple weighing in at 3% of the Contra Fund, whereas overall in the S&P it makes up about 6%. So these are two stocks where the manager is active and has made a decision and said, we expect Amazon to grow faster than the market, and we expect Apple to maybe grow not as fast as the market. Over on the far right is the Russell 1000 index and its composition in the top 10 holdings. The Russell 1000 is actually a better benchmark for Fidelity ContraFund because it fits in that upper right-hand quadrant, if you remember back to the style box. So that you notice the Amazon weightings are a little bit closer there. But again, huge differential in Apple. Apple makes up almost 11% of the Russell 1000 Growth Index, but just 3% of Fidelity ContraFund. The investment philosophy, so this is right from Fidelity, they're looking for above average earning growth in stocks that's not accurately reflected in the current valuation. So every actively managed fund, they're looking for mispriced assets. They're looking for companies that are being valued at a rate that's less than where they would value the company. So in this particular instance, Fidelity ContraFund is focusing on earnings and earnings growth. So based on that metric, they're saying the market is mispricing the assets inside this mutual fund. In the second section, strong competitive position, high returns on capital, and solid free cash flow. So what that means is if you focus on the first three words there, strong competitive position. So they're looking for stocks that would have what we would call a wide moat, meaning there's barrier to entry there or there's barriers to another company getting that level of market share. So these are companies who have a dominant position in their marketplace, and it would take a long time for another company to catch up to that position. Key data on the fund, it's been around a long time, since May of '67, and Will Danoff's been there since 1990 as the portfolio manager. During that time, he has won Morningstar Portfolio Manager of the Year, and this fund has grown to $180 billion, so very large size mutual fund. In terms of holdings, it's got about 336 holdings. So when you compare that to benchmark S&P 500 and Russell 1000, it's a little bit more concentrated than those index, but certainly not a fund that we would consider to be a concentrated mutual fund. When we're looking at a fund like this that's actively managed, we look at the fees that go along with that, meaning the fees that you're paying as the investor. Is it worthwhile? Are you getting a rate of return that's better than maybe an index fund or something that would cost a lot less? So the main share class that holds most of the assets is ticker symbol FCTNX, and that carries a 86 basis points or 0.86% expense ratio. The other share class, which is most commonly found in retirement plans, is a little bit less expensive at 78 basis points. That ticker is FCNTX. So again, we're looking to see if this fund manager can outperform the index along with those fees. Whenever you look at mutual fund returns, the fees are always sort of baked into that number. This fund has outperformed the Russell 1000 in 4 out of the last 10 years, 2012, 13, 15, and 17. Another way I guess you could look at it is say it's underperformed the benchmark 6 out of 10 years, but that's what we're looking for. We're looking for outperformance of the Russell 1000 consistently. But cumulatively over the last 10 years, it's underperformed by 1.6% annually. So it doesn't seem like a lot maybe to some of you, 1%, but as that money adds up and compounds over time, somebody who was invested in the Russell 1000 or a Russell 1000 index fund would have performed significantly better than someone invested in the Fidelity ContraFund. In conclusion, I would say that the size of this fund make it tough for it to really outperform on a regular basis. With that 180 billion in asset size, he's maybe not able to move as quickly as some other funds when the market is going through some changes. So that underperformance against the benchmark. A couple things in ContraFund's favor. The size of the fund can actually be an advantage because they hold such large positions in some of these stocks. They get very good access to management of these companies, so that can help them. And also one of the things that's helped ContraFund is it has performed better during down periods. So we saw that when the pandemic first started in calendar year 2020, when the market pulled back a little bit, Fidelity ContraFund didn't pull back as much. So because of that, I'm giving it an overall B grade. There's a lot of very good funds in the same category, that upper right quadrant, large cap growth. So if this fund, if it's in your portfolio, you might want to take a look at some other options and just see what else is available. Certainly if it's in a retirement plan lineup, hopefully you're benchmarking it regularly, but this is something you want to keep an eye on. If you're watching this on my YouTube channel, please check out my Facebook group. That's where all these videos are posted first. And also, if you're part of that Facebook group, you'll have a say in what funds get reviewed going forward. If you're watching this video in the Facebook group, be sure to check out my YouTube page to make sure you're subscribed to get all the alerts of the upcoming fund reviews. Plan sponsor services, we offer 338 plan consulting, participant education. We also work with individuals and families. We also provide some advisor support on the 338 side or some TAMP outsourcing if you're looking for that as well. So thanks for watching this video. And again, be sure to log on to that Facebook group so you have a say in what funds get taken a look at going forward. Thank you.